What I want to do today is to finish up talking about the weighted average cost of capital that we were doing in class number 5, and then go on and talk about sensitivity scenario and break-even analysis. Okay. What they found was that if you looked at actual returns, this is the 1992 Journal of Finance. So they looked at actual returns, and they regressed them on the size of a firm. Size is measured by the market value of the equity. And what they found was that smaller firms had higher returns, even controlling for their beta. So this variable was less than 0. So just simply accounting for the market capitalization, price times number of shares outstanding of a stock, appeared to be an important predictor of its expected return. Okay, an important factor in that determination. The other variable they looked at was something called the book-to-market ratio. This is the book value of equity to the market value of equity. And this was counterintuitive because they found that this was positive. And my intuition, at least before this, would have been negative. Because if you think about high book-to-market firms, those are firms with, by definition, low market values of equity to book values of equity. But here's the big thing they found. When you looked at their beta, nada. Beta didn't matter. Now, I will tell you, this did not make the NBC nightly news. Okay? Well, it was a little bit like that in the finance area. We were saying beta, 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 and then Baum and French were saying, don't use beta. Okay, Kellen.
Well, I'm curious about what types of firms were in those, the ones that dip off. Mm-hmm. How big of a deal were conglomerates? You have a big company with lots of teeny little subsidiaries.
Actually, they'd be more likely in the low beta. Okay. So these firms tended to be smaller firms and firms with high ratios of book value to market value.
Okay.
Right. And so what Baum and French found was when you accounted for that, this relationship completely collapsed. How?
So why did they necessarily pick 1966 to 2008? Just because their relationship broke down in that period? Or are there other examples?
Yeah, because, right. Good. The answer is there's no theory that tells us that 1966 was the magic break point. It was really just the data. They looked at the data and said, well, if the capping is true, it shouldn't be only true for a particular time period. It should hold for various sub-periods too. And what they found is for this relatively long sub-period, the model is, at best, highly incomplete. Okay, clearly breaks down for high beta stocks. Okay, make sense? What about the risk-free rate? How do we estimate something like that? Got it?
So you'd want to figure out a risk-free asset that is as long as you expect the company to last. And you go into the assumption that the company's going to last forever, but it seems to me you also have to think about how frequently the asset's traded. So typically don't use like a 10-year T-bond.
Good answer, the 10-year. The 10-year T-bond is a good rule of thumb that's often used. Why would that graph be rising?
That investors anticipate a rise in rates.
Right, a rise in what? What kind of rates?
Long-term rates.
Or spot rates. They're expecting spot rates to go up, right? So if we're discounting long-term cash flows and the yield curve is upward sloping or just not flat, we could be miscalculating the present value of those long-term cash flows because we're not matching whatever the market might expect, say, in future inflation to be beyond the duration of the short-term rate. Okay, so it's not appropriate to use a short-term interest rate for long-term cash flows. Short-term in this case is a treasury bill rate or a treasury note rate.